Hi everyone, and welcome to the Wealthy Education Technical Indicator video on exponential moving averages. I'm Stephen, and I'm happy to have you here today. So let's talk about exponential moving averages. A simple moving average is calculated by adding together prices in a given time frame and dividing by the number of time frames. So if we're looking at a simple daily moving average, we're going to take the closing price for a certain number of days, add those numbers together, and then divide by the number of days. So say we're doing a simple moving average for a 10-day period. We'll take the closing prices for the past 10 days, add those together, and divide by 10. An exponential moving average is a weighted moving average. So the final few days of that moving average, using our daily example, would be more heavily weighted. Both the simple moving average and the exponential moving average are based on historical prices. One question is, how does a moving average based on historical prices help us predict future prices in a stock? As we'll see in the chart in just a second, an exponential moving average by itself isn't extremely helpful in predicting price moves, as by the time the moving average is changing direction, the stock has already moved in that direction. But a two-line exponential moving average can help us know before it's clear on the chart whether a stock that's trending is slowing in that trend and may be about to change direction. When we use two EMAs with different time frames, we get an indicator when the fast line or the signal line, which is the lower number of time frames, crosses the slow line, which is the higher number of time frames. And we'll look at an example in a chart in just a second. A golden cross, which you may have heard talked about in the press, is when a short time frame crosses a much larger time frame. So one example would be if a 50-day moving average crosses a 200-day moving average. That doesn't happen that often in stocks on a daily basis or in markets on a daily basis. So when it happens, you may hear reports about it in the press. Now let's look at how to set up exponential moving averages on a few charts and see how the indicator works. We're going to start by looking at the dollar-yen currency pair. We're going to assume we're trading this currency pair on an hourly basis. And as always, we're going to start with a larger time frame to get an idea of whether the pair is trading in a bullish, flat, or bearish market. We can see here on the daily chart, the pair moved down at the early part of the year in a bearish trend, bottomed in the March-April timeframe, and then has moved up through the July-August timeframe in a bullish pattern with a few pullbacks in late May, and we're in another pullback right now. To me, this pattern is fairly neutral. I wouldn't call it bullish or bearish at this point. We seem to have some support around 110. We had price action around this level in February, again in May, and in June. And the pair has bounced off of this level again in mid-August. So we have a fairly neutral stance with 110 being something of a support level. We're now going to look at a 4-hour chart before we go to our hourly trading chart. The 4-hour chart is fairly bearish, but again, we know we have support here around 110, and the stock is trading close to that. So we may either want to look for another bounce off of 110 or for the pair to break through 110 to the downside. So that's the information we have going into our hourly chart. Now we're going to go to the hourly chart, and we're going to set up our exponential moving average. We're going to go to indicator at the top, type in EMA to get moving average exponential. We'll close that. We'll come over and these are our settings for our moving average. And what we're going to use is a 20-day and a 5-day. Our 20-day is going to be our slow line, and our 5-day is going to be our fast or our signal line. So we'll start by clicking on Format, and we'll make this our fast line. And we'll make it a 5. And then for style, we're going to make this a green line. And hit OK. And now we're going to hit indicator again. EMA. This is going to be our second slow line. So go here to Format, and we'll type in a 20. And we're going to make this a red line. Okay. So what we're going to be looking for is a cross of our green line over our red line. And let's look at how that's worked in the past couple of days on the hourly chart in this currency pair. we have a cross of the green line here when the pair was at 110.84. We'll see that the pair sold off. We have another cross to the upside at 110.56, which lasted only a short time, a couple of hours. Another cross back down to the downside, and that's when we had the test of the support level around 110. The pair dropped to 109.80. It bounced there, and you see the EMA crossed here for a buy signal and back down. You can see there are a lot of crosses of the EMA. So generally, we're going to be using the cross signal along with another signal, such as a relative strength indicator, which we'll talk about later, or a candlestick pattern. So I'll show you a quick example of two candlestick patterns to go along with the EMA. We'll go over these candlestick patterns in more detail later. But this pattern, where we have a red candlestick, remember the red is the down candlestick, after a green candlestick, and the red is larger, it's a bearish engulfing pattern. So if we see that pattern, we're then going to look for a cross to the downside to confirm the pattern. And here we have that cross down. The pair trades down, and here we have two candlesticks together that are about the same length. The first one is a continuation of the downtrend. So this is a down hour. And then we have an hour that's an up hour just after the down hour that matches this candlestick. And this is a bullish pattern. After we see a bullish candlestick pattern, we're going to be looking for a cross to the upside. This would be our buy signal here. And remember, with each trade that we place, if we have a buy signal here, we're then going to have a stop. And depending on our trading plan, it would be somewhere below this level. And what I might do in this case is if we purchased here, we may want to use this low where our candlesticks indicated a turn in the pair as our stop point. As we can see, we would not have been stopped out and the pair rallied. So that's how to use the EMA on a short-term time frame. And now let's take a look at an EMA pair on a daily chart for a stock. Let's take a look at a daily EMA for the S&P 500. This is a 50 and 200-day EMA, which is fairly common for identifying long-term trends in markets and stocks. You'll note the market had been in an uptrend in late 2015, which it had been in for several years, and there was a cross here of the 50-day below the 200-day. And if you were trading the market at this time, you would have heard a lot of chatter about the golden cross to the downside. People became anxious around this point, and if you were trading long-term, this would have been a good time to either exit or been short the market. But as you'll notice, in April of 2016, the 50-day moved back above the 200-day and has stayed there ever since. This golden cross to the upside kicked off another leg of the bull market in 2016, which has lasted until today with no crosses below the 200-day exponential moving average. Thank you for watching this video on the exponential moving average. We'll see you next time when we'll talk about the parabolic SAR indicator. See you there.